Okay, in this video we're going to look at the 2023 sole trader final account, which was for V. Leahy. Okay, so as always we're going to take it step by step, so 5 steps. So step number 1, laying out our accounts. Step 2, transferring your figures into the accounts from the trial balance. Step 3, calculate investment income and debenture interest for the year. Step 4, complete your adjustments. And step 5, tot up your totals. So this is what your end product is probably going to look a little bit similar to. So this was a 2015 company account. So as you can see, all the workings are done on the face of the accounts. Okay, so step 1, lay out your accounts. So you can pause the video and copy down the layout. Be very careful to copy it down exactly as you see it. Step 2, transfer your figures into your accounts from the trial balance. Okay, so here at this point in time, we're going to just be looking at the trial balance. So we have to be very careful to remember that our assets and our expenses are on the debit side and your liabilities and revenues are on the credit side. Liabilities and assets go in the balance sheet and then expenses and revenues go in the trading profit and loss. Okay. So looking down through the trial balance, then we're going to identify where everything needs to go. So patents is going to go into intangible fixed assets. We'll worry about this information in the brackets later. Land and buildings and then the accumulated depreciation in the land and buildings are both going to go into the tangible fixed assets. Delivery vans and the accumulated depreciation of delivery vans are both going to go into the tangible fixed assets. And equipment is going to go into the tangible fixed assets. Discount on the credit side, that is a revenue, so that is discount received. So if it was on this side, it would be discount allowed. If it was on the debit side, discount allowed, because that would be an expense. But because it's on the revenue side, it is discount received. So that is going to go into TPL add operating income. 4% investments, they're going to go into the financial fixed assets. Stock on the 1st of the 1st is going to go into the trading account in the TPL, as is sales and purchases. Salaries and general expenses, they're going to go into the TPL under the admin heading. So we've got an admin heading and a selling and distribution heading, and that's going to go into the admin heading. Next, we've got advertising, that is going to be selling and distribution expenses. Then we've got investment income received. So that is balance sheet, current assets, investment income due. So that is going to help us calculate how much investment income is due at the end of the year. Next, we've got drawings. So that is balance sheet, finance by, under capital and reserves. And we're going to be taking that figure away from our net profit figure. Rates, we're going to put that in our TPL admin expense. PAYE, PRSI USC, we are going to be putting that into creditors minus 1 year. The same with VAT and bank, because they are all on the credit side, so they're all liabilities. And VAT, PAYE and bank, like they only ever go in the balance sheet anyway. Okay, so they're all creditors minus 1 year for all three of them. 3% fixed mortgage, including 50,000 issued on the 1st of the 6th, 2022. Is 320,000. So they got a top up on the mortgage of €50,000 after the 5th month, so in the start of the 6th month. So for 5 months of the year, they had 320 minus 50. So 320 minus 50 is 270. So they had 270 for 5 months, okay? Whereas now they're going to have 320 for 7 months. So we'll look at that when we're working out the fixed mortgage, but the fixed mortgage itself is going to go into balance sheet financed by creditors plus 1 year. Now, the mortgage interest for the year, okay, is always going to be more than the interest paid. So here it just says that interest was paid for the first 4 months. So look, we will have done it for a year, okay, and we have had it for a year, but then we've only paid it for 4 months. So that is going to let us know we're going to have some mortgage interest due. Okay, we've only paid it for 4 months of the year. We're going to have some mortgage interest due at the end of the year, And you're going to have that in every single question. Okay, so every single question we're going to have that. But mortgage interest due at the end of the year would go into creditors minus 1 year. Okay. Then you're going to have debtors and creditors. So debtors is current assets, and creditors minus 1 year is where creditors is going to go. Okay. So that is that. Bad debts provision is going to come away from your debtors figure. Okay. So that 2,100 of the 67,700 debtors that they have, they are assuming that 2,100 is not going to be received from those debtors. Okay. So it's just to be careful, okay, to take care when they're preparing their balance sheet to show that, you know what, your debtors aren't actually 67,700. They might be a little bit less. So we're just providing for that here. And then capital is going to go in balance sheet, financed by capital and reserves. Okay, so that is just us identifying where everything is going. And it's just very important for you to do your alert diagram at the top of the trial balance every time that you do that. Okay, so for us now, we're going to put it into the accounts. Okay, so when you're learning, we will be identifying where everything is going. Okay, and you could be writing that down. But when you are very secure with it, you know exactly that you're right, you know you've put everything into the right place, you don't need to do that. Okay, you can just put things straight in. So your patents are going to go in the intangible fixed assets, as are all of your fixed assets, so land and buildings, delivery vans, equipment. The first brackets here is for the cost of the fixed assets, and then any second bracket here, that is your accumulated depreciation working. So 2 sets of brackets for all of these. First one, cost. Second one, accumulated depreciation. Then we're going to have the discount received. Then we're going to have the 4% investments. Then we're going to have opening stock. Then we're going to have sales. Then we're going to have purchases. Then we're going to have salaries and general expenses. Then we'll have advertising in the S&D. Then we'll have investment income received. So we're going to have investment income due, and it'll be whatever it is for the year minus what we have already received. So we've received 2,200 here. Drawings, 45,000. Rates, 42,800. PAYE, VAT and bank, you've got 4700, 11900 and 53600. Then you've got your 3% mortgage, 320,000. Then you've got your mortgage interest paid for the first 4 months. So you've got whatever the amount is for the year, and then minus what it's saying that we've paid up here. So in this case, it's 2,300. Then we've got our debtors, 67,700. Then we've got our creditors, 98,600. Then we've got bad debts provision, which is 2,100. And then we've got capital, 762. So you need to be careful that you are entering all of those figures incorrectly. So whether it be that you get a highlighter and you highlight the figures once you've put them in and checked them. Okay, so that would be step 2 complete now. Next step, step 3, calculate investment income and debenture interest for the year. So that'll take 3 or 4 minutes. So just a reminder here, our investments go into the financial fixed assets. Our investment income goes down the bottom of our TPL, and that is going to be the amount that we are due to get for that current year. And it doesn't matter if we've received it or not. If we are going to have any amounts that we have yet to receive for the current year, that is going to go into current assets. And just so you know, that's going to happen in every single final accounts question. With regards to our mortgage then, so our mortgage, the actual liability, goes into creditors' amounts falling due after 1 year. The mortgage interest for the year will go into the trading profit and loss, and that's doesn't matter if we have paid it all or not. Okay, it's going to go in there. All right, and then any amounts that is due at the end of the year, mortgage interest due, that is going to go into creditors' amounts falling due within 1 year. And again, like the investments, we're going to have that every single year, just so you know. So back to our Leahy question, what is the investment income for the year? So here we have 180,000 investments. They are 4% investments, so we're earning 4% in them. We acquired it, we bought it on the 1st of the 7th. So we're going to have it for all the 7th month, 7, 8, 9, 10, 11, 12. So that is 6 months of the year, €3,600 there. With regards to the mortgage then, we've got, I talked to you about this already, but we have a 3% fixed mortgage, including 50,000 issued on the 1st of the 6th, 2022. So for the first 5 months of the year, they had 320 minus 50, which is 270. Okay. And then after that, they got the top up of 50, bringing it up to 320. We're multiplying both of them by 3%. Okay, and then the first 5 months of the year we had the 270, and then the last 7 months of the year we had 320. So you multiply them both out and you tot them up and you get 8,975 mortgage interest. So you can just do this workings on the face of your accounts. Okay, so the 3,600 goes there, and then investment income due is going to be the 3,600 minus the 2,200 that you have already received. And then the mortgage interest, again, you can just do the workings on the face of it, right? The answer here is 8,975. I have it over here. I don't have it written down here, because in sole trader final accounts, a lot of the time the sole trader lives in a part of the building that the mortgage is related to. So I'm going to wait and see, but there's no problem putting it here in the bracket, and then later on just, you know, getting your the Tipex mouse thing and putting in the proper figure. But anyway, 8,975 goes there, and then the mortgage interest due in creditors minus 1 year, 8,975 there. Okay, so that is step 3. It's going to be a valuable step for you to get into the habit of doing when you get into your section 2 questions of the course. So this is it. This is what your final accounts are going to look like after step 1, 2 and 3. And also forgot to mention at the start, when you have your layout, right, very, very, very important, okay, that you're writing trading profit and loss account for the Y/E or year ending 31st of 12th, 2022. So you have to put in the date. Okay, so if you don't put in the date, it is not going to get the marks. They usually give the mark for the first account and not give it for the balance sheet, but they might change that up some years. So just take care, write out exactly what it says in the question. Like part A asks you to do the trading profit and loss account for the year ended 31st of 12th, 2022, and the balance sheet the same. So you can just copy them right out of the question. Okay, step number 4, we're starting our adjustments, and we've got approximately 32 minutes in which to do them. Okay, so we will get started. So here we go. Plenty of adjustments. We've got 9 adjustments there. Looks like quite a lot of adjustments. If you compare it to sole traders from years and years ago, they're really beefing them up a good bit. But yeah, you should expect to see something like this in your year. Now, number 1, stock at cost on the 31st of the 12th, 2022 was €82,600. This figure includes damaged stock, which cost 5,800, but which now has a net realisable value of 75% of cost. Okay, so they had bought stock 5,800, but it's not worth that anymore. It's only worth 75% of that now. So lovely and easy adjustment straight away. We're just getting 82,600. We're taking away the 5,800, but then we're adding back the 75% of that. So if you worked out what 75% of 5,800 is, it's 4,350. So you're just adding that back in there. And then you're also putting it in to the current assets as closing stock. So closing stock as per TBL there. Okay, so that's basically it. Okay, that's that adjustment done. Next adjustment, we have goods purchased on credit from a supplier were in transit on the 31st of the 12th, 2022. The invoice for these goods had been received for 15,375, which included VAT at 23%. No record was made in the books in respect of this transaction. Okay, so goods are in transit at the end of the year. Goods are in a van, on a motorway somewhere, end of the year. The invoice for these goods has been received, okay? So we already know it's purchases on credit, but if we weren't told that, the invoice has been received. Invoice received means I bought something on credit, okay? So that would be purchases on credit as well. So they didn't even need to tell us this because they told us invoice had been received. Okay, now it had been received for 15,375, which included VAT at 23%. So this 15,375 is 123%. Okay, so they're loving a bit of the VAT adjustments now these days. So you have to make sure that you are ready for the VAT adjustments. So look, 15,375, which include VAT at 23%. No record was made in the books in respect of this transaction. Okay, so basically, right, our liability creditor, okay, increases on the credit side. It increases by the amount that we have to pay them. We have to pay them 123%. They're going to keep the 100% and then they're going to send the 23% off to the revenue commissioners. So for the creditor, we are giving them 123%. The expense purchases is only going to increase by the 100%. Okay, so for us to find out the 100%, we simply divide the 15,375 by 123 and then multiply it by 100 to get our 12,500. Now, what about the VAT? So VAT has to be recorded on the same side as the item that it is attached to. And in this case, it is the purchases account. Okay, so we have to debit that also. All right, so 12,500 on the debit side, 2,875 on the debit side. Now, why do I have the trial balance out here? I'd say you're wondering, right? I'm doing that to show you that the VAT here is on the credit side. So in the trial balance, this is where the VAT is, okay? So what we're going to be doing to the 11,900 is we are going to be, therefore, minusing 2,875 from it because it's on the opposite side, okay? And then the 31st of the 12th, 2022, that's closing stock, okay? So we're going to, whatever we do to the purchases, we're going to do the same to the closing stock. So let's look and see how this is in our accounts. So purchases plus 12,500, closing stock plus 12,500. That's also going to affect the closing stock here. The creditors, we're going to add the 123%, and then the VAT, we're going to deal with the 23% there. And we know why we minused it. It was because the VAT figure in the trial balance is on the opposite side as what we had to do back there. Okay, so that is adjustment number 2 done. All right, adjustment number 3. Provide for depreciation on delivery vans at the annual rate of 20% of cost from the date of purchase to the date of sale. Note, on the 30th of the 9th, 2022, a delivery van which had cost 35,000 on the 30th of the 6th, 2018 was traded in against a new van which cost 80. Okay, an allowance of €3,000 was given on the old delivery van. The bank transfer for the net amount of this transaction was entered correctly in the bank account, but was incorrectly treated as a purchase of trading stock. These were the only entries made in the books in respect of these transactions. So we have got an old van, okay, Leahy has an old van that they're going to leave with the Ford garage or the car dealership, and they are getting €3,000 for that old van. They're going to drive out in this new van here, which costs €80,000. Okay, we're also being told that we need to depreciate vans for the year, and we're also told that the bookkeeper did absolutely nothing bar record the bank transfer for the net amount. So whatever the amount was that Leahy had to give the dealership to be able to drive out in the new van, that was incorrectly treated as a purchase of trading stock. Okay, so that is the correct there. We've got a good few things to do here, so we'll get started. So the first one here, fix the purchases figure. So the new van cost 80. We got an allowance of 3 on the old van from the Ford garage. Okay, so that means that we had to pay the Ford garage 77 grand, or Leahy had to pay the Ford garage 77 grand in order to be able to walk out. That amount was incorrectly treated as purchases. So we are going to fix the purchases figure. So delivery vans will be debited, purchases are debited. So therefore, to take it out, we're going to credit it, and that is going to be minus 77,000 euro there. Then we will find out what the cost of vans is at the end of the year. Okay, so we sold an old van, and we bought a new van. So the selling of the old van, right? The old van cost 35, the new van cost 80. So we're going to minus 35 and add 80, and that is going to have, we're going to have a cost of 525,000. So 480 minus 35 plus 80, 525,000, and that's the cost of the new van. So next we're going to do the depreciation charge for the year. So we're told here, provide for depreciation on delivery vans at the annual rate of 20% of cost from the date of purchase to the date of sale. So we have to remember here that we have vans that were worth 480 at the start of the year, and now they're worth 525 after we sold the old and bought the new. So we have to look and see what was the date that this trade-in happened, okay? So it happened after the 9th month. So for the first 9 months, we had 480,000 worth of vans, multiply them by 20% depreciation for the year, and that's 72,000. And then that went up to 525. So that 525 by 20%, we're going to multiply that then by 3 over 12. And that's 26,250. So altogether, we are going to have depreciation on delivery vans 98,250 euro. Okay, so that is the depreciation on delivery vans there. Next, we're going to work out the profit or loss on the sale of the old van. So we have a formula to use. It is cost minus the accumulated depreciation, and this is all on the old van now. That is equal to the net book value. And then we compare it to the allowance, and then that'll be a profit or it'll be a loss, and we just have to work out which one it is, okay? So the old van, right, was bought on the 30th of the 6th, 2018, and it was sold on the 30th of the 9th, 2022. So for 2018, we got it at the end of the 6th month. So that means that we had it for 6 months of the year for 2018. 2019, we had 12 months. 2020 we had 12 months, 2021 we had 12 months, and then 2022 we had it for 9 months of the year. Okay, we tot all that up, that is 51 months of the year, that are 51 months over the 5 years that we had that old van. So to work out the profit or loss, we have the cost of the old van, which is 35. We take away the accumulated depreciation. So 35,000 multiplied by 20% multiplied by 51 over 12 months gives us 29,750 euro, and then that gives us a net book value of 5,250. We will compare that then to the allowance. So if you remember, we got an allowance of 3,000 for that old van, and so it was worth 5,250. We only got 3,000 for it, so unfortunately that means that we made a loss on the sale of the van. So the figures that we'll be getting the marks for is the cost minus the accumulated depreciation, and then comparing it to the allowance of 3,000, and then 2,250 is the loss on the sale. Okay, so lastly then we have the accumulated depreciation on all vans. Okay, so we had 70,000 depreciation, that was from the trial balance. Okay, what we're going to do then is we're going to add the depreciation charge for the year, which is the 98,250, but then we're going to take away the accumulated depreciation on the sold van. So we no longer have that, so we can minus that, okay? So in our balance sheet then, we've got a cost 525,000. Our accumulated depreciation is 138,500, and our net book value is 386,500. So that is the net book value there. And that's the vans adjustment. So if you need to practice that, make sure you just look back at the delivery vans adjustment in the playlist for the question 1 adjustments. So part 4, the suspense figure arises as a result of the incorrect figure for mortgage interest, although the correct entry had been made in the bank account, and discount received of €600 entered only in the discount account. Okay, so we are going to use our trial balance to help us here. So the suspense figure arises as a result, incorrect figure for mortgage interest, but the correct entry will be made in the bank account, so we don't have to touch the bank account. So we're just going to look at our mortgage interest paid. So this figure here, they're saying that this 2,300 is incorrect. So mortgage interest paid for the first 4 months. So we need to look at our fixed mortgage information here. We've got a 3% fixed mortgage, including 50,000 issued on the 1st of the 6th, 2022. So before my top up in the first 4 months, I would have had a mortgage of 270. So 270 multiplied by my 3% interest rate, multiplied by 4 over 12, that gives me €2,700. So I've got 2,300. I'm going to add 400 to that. My two sides do not equal now, so I have to get my two sides to equal. So how am I going to do that? I am going to add 400 on the debit side, so I've done that. I'm going to have to do something else with 400 then to my salaries and general expenses. So for my two sides to equal, I'm going to have to minus the 400. So now my two sides equal again. So when I was just plus 400 up on the debit side, I didn't equal. But if I go to my item incorporate in suspense and I minus 400, we're going to equal again. So that is the first part of that suspense error done. The second part is discount received of 600 entered only in the discount account. So discount received of 600 entered only in the discount account. So we need to think about it, right? So we need to think, what other accounts does it need to go into? Okay, so discount received 600 entered only in the discount account. So we need to say to ourselves, right, who do we give a discount to, or who do we receive a discount from? Okay, who do we receive a discount from? So the discount, all right, is going to be received from a creditor. So a creditor gives us a discount. Okay, creditor gives us a discount. So what we need to do, all right, is we need to look at the creditor account and we need to say, right, okay, they're giving us a discount. So the liability creditor, all right, will have to be reduced by 600. Okay, so 98,600 minus 600 there. Okay, because my creditors, I do not owe them the 98,600 anymore. I owe them 98,600 minus 600 because they have given the Leahy a discount. Okay, when I minus 600 on the credit side, my two sides are not going to equal now. So what I'm going to have to do, I'm going to have to minus 600 then from the debit side. Okay, so if I minus 600 here on the credit side, I'm going to have to minus 600 on the debit side in order for those two sides to equal. Okay, so for me to now put these into my accounts, okay, I am going to have my salaries and general expenses. I'm going to minus 400, minus 600, and then my mortgage interest, I'm going to just cross it out here and I'm going to minus 2,700. And then my creditors, I'm going to minus 600. Okay, so you should have minus 15,375 there as well. I don't know why it's not there yet. That should be there as well. So minus 600 here. And that is your suspense adjustment completely done. Okay, number 5 then. So you've got patents incorporating 2 months investment income are being written off over 10 years, which commenced in 2020. Okay, so patents incorporating 2 months investment income are being written off over 10 years, which commenced in 2020. Okay, so first of all, this is a huge mistake by the bookkeeper because patents are an asset account, all right? And investment income is a revenue account. So why did the bookkeeper put a revenue in with the assets? There was absolutely no reason why they did that, okay? Absolutely no reason why they did that. It was a complete and utter mistake, all right? So the fact that the revenue was put into the asset account, complete mistake by the bookkeeper. If you put in, so the patent account, right? So the patent account, asset account, increases on the debit, decreases on the debit or on the credit. So the patent was in here, right? And the bookkeeper put investment income in, they would have put it into the credit side because that is a revenue account, okay? So it didn't say that they put it in on the wrong side or anything. So for us to take away this investment income, we would actually have to add it into the patent account as well. So complete mess up by the bookkeeper. And just so you know, right, this is basically, right, them just testing that you know your double entry. Okay, that's all it is. Now we are doing these accounts for 2022. Okay, so 2022 we're doing these accounts for. So patents are being written off over 10 years, which commenced in 2020. So 2020, right? 2020, we have it written off. 2021, right? We haven't. Okay, sorry, we have. But 2022, we haven't done that yet, right? So we have got 2 years already written off. Okay, so 2 years already written off out of our 10 years. So we only have 8 years left to do. Okay, so we'll bear that in mind whenever we're calculating the patents written off. But just looking at the trial balance to show you the situation with the investment income. So the patents have, if we look for it here, where's the patents? Yeah, up in the top here, incorporating 2 months investment income. So we said definitely shouldn't have gone in there anyway. But if we want to work out how much the investment income should be, it is 180,000 multiplied by 4% investments multiplied by 2 over 12. Okay, and that is €1,200. All right, so now, as I said before, investment income should be recorded on the credit side. And so then what we will do, obviously you know that doesn't equal then. So if we fixed this and put it where it should be, to fix it up in the patents, we're going to have to add that to the patents as well. Okay, so that takes the investment income out of it, even though you really want to subtract it because that feels like the natural thing to do. But because of double entry, you have to add it. So 48,8 plus 1,200. So the patents were actually 50 grand. And they have to be written off over 8 years. So 48,800 plus 1,200 divided by 8 years, that is 6,250 is your patent written off. Okay, now that 6,250 is patent written off, so we have to reduce the value of our patents, the 50,000 minus the 6,250. So that actually gives me 43,750. Okay, so 43,750 euro there. Now, we got the 1,200 investment income. So I have to show that I did receive that investment income. So that is going to reduce the amount of my investment income due then at the end of the year. Okay, so that is that. Now, that's the patent adjustment done. All right, so adjustment number 6, goods taken by Leahy for his own personal use during the year were not recorded. The goods had a retail value of 3,600, which is cost plus 20%. Okay, so what is drawings? Drawings is just when an owner takes something out of the business. So if this is the owner here, they're just taking something out of the business. It can be goods, it can be money, it can be an expense, whatever it is. It's just that they're taking something of value from the business, okay? When it is goods, okay, very important to look during the year. So there is nothing here about the 31st of the 12th. A lot of people want to take this out of closing stock, right? But it is not closing stock because it does not indicate at all that it was the end of the year, okay? So goods during the year, that is our purchases figure. So the amount here, the retail value was 3600, which is cost plus 20. So we have to say, okay, 3600, if we divide that by 120 and then multiply it by 100, that will be our cost price, okay? And we are going to take the goods out at cost price. So we're minusing 3,000 from purchases, okay? And we are adding 3,000 to drawings. And that is that adjustment completely done. Adjustment number 7 now. The company revalued the land and buildings at €950,000 on the 1st of the 1st, 2022. The land element of this new value is €200,000. The revaluation has yet to be reflected in the accounts. Buildings are to be depreciated at the rate of 2% of cost per annum. Okay, so reading that again, company revalued the land and buildings when they revalued them at the start of the year, and they revalued them to 950,000. The land element of this new value is 200,000. Why are they telling us this? They are telling us this because we do not depreciate land, so we will have to take that 200 out whenever we are calculating the depreciation. Then it says the revaluation has yet to be reflected in the accounts. So I have to put the revaluation in the accounts. And then it says buildings are to be depreciated at the rate of 2% of cost per annum. So we have to, they're telling us the depreciation rate here. So first of all, what we'll do is we'll do the depreciation charge for the year. So the buildings were revalued at the start of the year. So we're going to use the figure that it told us here that they were revalued at on the start of the year. Okay, so in the trial balance it did say 850, but it said that the revaluation hadn't taken into account yet. So that 850 is actually 950. Okay, so company revalued land and buildings at 950 on the 1st of the 1st. So the 950, we're going to take away the 200,000, right? That's 750, and we're then going to multiply that by 2%, and that will work out to be €15,000. Okay, then, right, what we're going to do is we're going to bring up our cost. Then is 950. Okay, the depreciation, because it was revalued at the start of the year, we've got the depreciation charge for the year here, 15,000. Okay, and then what we're going to do is we're going to have 935,000. Okay, is the net book value. All right, so 950 minus 15, that's equal to 935. Now, when we revalue land and buildings, okay, we're going to have a revaluation reserve. It's just going to show that we are sitting on something of value. So Leahy has something of value here. Okay, they are a sole trader, all right, and down the finance by, we have to show then that they're sitting in something of value, and it's going to be revaluation reserve. The reval reserve is 205,000. How did we get this figure? Well, the 100,000 is the difference between the 850 that it was worth in the trial balance and the 950 cost that it has now. And they are adding back in the 105,000 euro there as well. So that is 205,000 altogether. Okay, so that is how you do the reval reserve. So that's adjustment number 7 done. Moving on to adjustment number 8 is our bank figure. So the figure for the bank account in the trial balance had been taken from the firm's own records. However, a bank statement dated 31st of the 12th, 2022 has arrived showing a bank overdraft of 50,300. A comparison of the bank account and the bank statement has revealed the following discrepancies. So, number 1, a credit transfer for 1,500 had been received on the 31st of the 12th, 2022 in respect of a debt of 1,700 previously written off as bad. The debtor has agreed to pay the remainder within 2 months. No entry was made in the books to record this transaction. And number 2, a cheque for $1,800 issued to a director had not yet been presented for payment. Okay, so you can lay out your bank adjustment like this, okay, 3 columns. What other accounts are affected in the first one? We're going to have the bookkeeper's bank figure here, and then just imagine AIB bank figure here. So the bookkeeper's bank figure is taken from the trial balance. It's on the credit side, so it's 53,600 overdraft. And then the bank statement figure is taken from the text, okay, so adjustment number 8, the bank overdraft figure there, 50,300 overdraft. Okay, so discrepancy number 1. A credit transfer for 1,500 had been received on 31st of 12th, 2022 in respect of a debt of 1,700 previously written off as bad. The debtor has agreed to pay the remainder within 2 months. No entry was made in the books to record this transaction. Okay, so every single bank adjustment, you are either going to have bad debts written off or bad debts recovered as one of the discrepancies. And I have seen where they've done both of them as well. So always expect to see a bad debts written off or bad debts recovered. Now this one here, a credit transfer of 1,500 had been received in respect of a debt of 1,700 previously written off as bad. They've agreed to pay the remainder within 2 months, happy days, and no entry was made. So look, to record this transaction. This is bad debts recovered. We are delighted here with this because we've received money and they've promised they'll pay us back within the next 2 months. So this is bad debts recovered. Now, a credit transfer of 1,000 was received, okay? That should go into the AIB figure first. So AIB should know about that. It should just be the bookkeeper that has to make the entry, that just has to record the transaction in her books, okay? So 1,500 coming into the bank account, right? That is going to be minus 1,500, okay? Now, it was 1,700 previously written off as bad. So the 1,700 is the bad debts recovered. That's the 100%. So you're going to put like the 100% of the bad debt that was previously written off here. So all of it goes in there. And then the amount that the debtor has yet to pay will be added on to debtors. And then obviously the 1,500 into the bank is reduced from the bank overdraft. So that's the first part done. The second part, a cheque for 1,800 issued to a director had not yet been presented for payment. So whose issue is this, right? So this is basically that the AIB don't know about this yet. The cheque was issued to a director, okay? The director has gone away with the cheque in the back pocket, okay? And check in the back pocket, and they just haven't lodged it into their bank yet. So it hasn't come out of the AIB's bank yet. They know nothing of it, but the bookkeeper does know. They wrote the cheque, they got the cheque signed, and they sent the cheque. It doesn't say anywhere that the bookkeeper hasn't recorded this, so we've nothing to do in the bookkeeper's accounts, okay? But in AIB bank statement figure, whenever the 1,800 is cashed, it is going to increase the bank statement overdraft figure. So with these bank reconciliation adjustments, you should get the exact same bank figure when you've worked through all of your discrepancies. If you do not get the same bank figure, you have made a mistake somewhere, okay? This was a lovely and easy one. And basically that's that done. All we've left to do is to put the information into the accounts. So with the bank figure, right, we're just going to have the 53,600 minus the 1500, and then we can put in the 52,100 there. With the debtor figure, we're going to add the €200 that has to be added there. And then bad debts recovered, we've got 1,700, which is going to go into our add operating income. So we are absolutely delighted with the bad debts recovered. It is money that was previously written off as bad, and we are delighted with that. So that is add operating income. So that's where every other revenue, operating revenue goes, you know, apart from sales. Okay, so that's that adjustment. We're on to the last adjustment now. So note number 9. Provision should be made for the following. Number 1, investment income due and mortgage interest due. And here it says, note, 20% of mortgage interest for the year refers to the private section of the building. Okay, so 20% of mortgage interest for the year refers to the private section of the building. So investment income due and mortgage interest due. Okay, well, we've got the majority of the work done already, so we just have to tot it all up. So we had the 3,600 for the year. We received 2,200 of it. That was written in the trial balance. And then we had the patent, the amount that was left in the patent, so 1,200. So when we tot that all up, we just have our investment income due, €200 here. And then in the mortgage interest, we had 8,975 total, but then we take away the amount that we actually had paid, which was 2,700, and that gives us 6,275. So that's that all totted up. So that's the first part there. But then it says, note, 20% of mortgage interest for the year refers to the private section of the building. So we had 8,975. That was the total amount of the mortgage interest for the year. But if we have 20% of it goes into the private section of the business, 80% of it will have to go into the business. So 8,975 multiplied by 80% is 7,180, which is going to go into the business, into the TPL. Then the 20% of it is going to be added to the drawings, because when a sole trader takes out something from the business, okay, in this case it is an expense. So when, you know, part of the expenses relates to the sole trader privately, okay, that is going to be drawings. So we add the 1,795 there, and that adds up to, then we can tot that up, 49,795 is your drawings figure. So that's part 1. Part 2 says provision for bad debts is to be adjusted to 6% of debtors. Okay, so to remind ourselves, what is provision for bad debts? Provision for bad debts is we don't think that the debtors are going to pay us. Okay, so we don't think the debtors are going to pay us. So what we're going to have to do is, in the balance sheet, we just have to look for our new debtors figure. So our debtors figure is 67,700 plus 200, so 67,900. Then we're going to multiply that by 6% to get our new bad debts bad debts provision figure, because it's to be adjusted to, so we're just changing it. So multiply that by 6%, we get 4,074. Now, we compare it to what was already in the trial balance, which was 2,100, and unfortunately 4,074 is a lot more than the 2,100 that we had previously thought we were going to have written off. Okay, so 4,074 compared to the 2,100, that is not good news. So we are going to have an increase in bad debts provision there. So 4,074 up from 2,100, that is an increase in bad debts provision of 1,974. So 1,974, okay, increase in bad debts provision. So that was 2,100 minus 4,074, okay, so 1,974. So that's the new bad debts provision. And remember, bad debts provision is, we're just saying we might not receive that, okay, so that is what that is. All right, so last but not least then, equipment to be depreciated at 10% of cost per annum. So we're going to look at what was the cost of the equipment. The cost of the equipment was 153,500. Okay, we're going to multiply that by 10%. That gives us 15,350. Okay, which we're going to put in admin expenses. Then up in our balance sheet, then we're going to have equipment 153,500, which is the cost. We're going to take away the depreciation. The only depreciation is the depreciation from this year. There was no accumulated depreciation in the trial balance, and then that gives us a net book value of 138,150. So you've finished all of your adjustments now. completely done, right? You've finished them all. What you need to do now is just get your calculator and tot all of these up, and then, you know, just put them out into where they belong, and then do your taking away and adding as you need to. Okay, so tot up your totals. It shouldn't take you more than 5 minutes. If it is taking you more than 5 minutes, you need to put down the pen, move on to the next question, because you're going to make you're going to get more marks in a different question. Okay, so there's your figures, and here you have them all totted up. Okay, so from your sales, you take away your cost of sales, that gives you gross profit. You tot up all of your expenses, you take that away from your gross profit, and then that gives you your gross profit minus your expenses. You add then your operating income, right? So you add them, and then that is equal to your operating profit. You add your investment income, take away your mortgage interest, that is your net profit. You have to make sure in your tangible fixed assets, so all of your, not your tangible, in your fixed assets that you're adding, you're not forgetting to add your intangible, tangible and financial to give you 1683400. Your current assets, you're going to have to add them all up to get 157676. The creditors, you're going to have to add them all up to get 185475. You're going to have minus 27799 then to give you total net assets 1655601. Finance by, your 3% fixed mortgage is going to be added to your capital, reval reserve, net profit minus your drawings to get 1655601 there as well. So that is Leahy 2023 Sole Trader complete there.